Good morning, everyone. Thank you for joining us on a Saturday morning of our extended weekend. My name is Gaurav Kaushik, and on behalf of CFA Society India, I welcome you all to today's webinar with Mr. Anshul Saigal. We have over 80 members in attendance, and the count I see is increasing rapidly. We'll be in webinar mode, and I expect today's presentation to last approximately an hour. Post which we will open the session for Q&A. Request you all to reserve your questions till the end. It's my honor to welcome and introduce Mr. Anshul Saigal. Anshul held the position of Chief Investment Officer at Kotak Mahindra AMC PMS in his last assignment till November 2023. He has over 22 years of experience in the Indian capital markets, of which he spent over 16 years with Kotak PMS. In his prior work experience includes credit equity research with firms like ICICI Bank and JP Morgan. Anshul is a full-time investor and invests proprietary capital through his family office. Anshul is an MBA and an engineer by education. He is an avid reader and occasional chess and poker player. I have known Anshul for over a decade now and have admired him for his deep research, knack of stock picking at great times, and I have learned a lot from his deep understanding of behavioral finance. From the session today, titled Anatomy of a Mispriced Stock, I hope our audience too is able to benefit from the same and develop nuanced thinking perspectives. Thank you all again, and over to Anshul.
Thank you, Gaurav. Thank you for your kind words. Thank you, everyone, for making time on a weekend and for being here. I hope I'm able to add value to you through this presentation. And this is a sort of agglomeration of my experiences over the years. I should tell you that I started out as a cigar butt investor, which is that I used to look for really deep value opportunities, very cheap names, and invest through those. Over the period of time, I kind of graduated to a more nuanced approach to investing. Some of those learnings I'm going to express through this presentation, and I'll share some examples as well, live examples which I have participated in or my funds have participated in, for better understanding of what I'm talking about. Let's start here. As the title suggests, this is the anatomy of a mispriced stock. That's really what I'm going to talk about. What really constitutes a mispriced stock? What kinds are there? Things like that. This is the presentation flow. I will first, to commence my talk, I will have to explain what a stock is, because from that flows the entire flow of the presentation. Thereafter, we will go to what are mispriced bets. Is mispricing equal to cheap valuations? What are the types of mispricings? Margin of safety and asymmetries. This will be the flow of the presentation. What is a stock? Let's look at an example of something that we participated in at Kotak PMS, and which is somewhat of a favorite of mine, this example, because this was one of the early investments that we made, and I really enjoyed making this investment. This is, firstly, stocks are fractional ownerships in businesses. They are not tickers that go up or down with the mood of Mr. Market. This is what Benjamin Graham used to say. Let's delve a little deeper into that. Let's look at the example of Patni Computer. Disassociate fundamentals from stock price. This is the stock price of Patni Computer. The name got changed to Patni Engineering later. The stock used to be about 550 odd rupees prior to the Lehman crisis. And in the crisis, it fell to as low as 97 rupees. So nearly over an 80% fall in this stock around that time. If you looked at the stock at 97 rupees, the market cap was about 2,400 crore, and the company used to hold cash and equivalents of 2,000 crores. And then, if you looked at the operating profit of the company, it was about 500 crore. It used to generate operating cash flow of about 450 crores. What this tells you is that it's akin to you buying a real estate property, paying a crore of rupees to buy that property, and by some stroke of luck, the previous owner leaves that property to you with a crore of rupees left in cash in the property. So basically, the property becomes free because you're getting as much cash as you spend to buy the property. This situation was something similar to that. And looking at it in a different perspective, let's look at Patni Computer through the eye of a leveraged buyout. How would, if I was an LBO participant, how would I look at this company to see if this had an opportunity or not for me to take advantage of? Let's look at the debt capacity of Patni Computer. It had an operating cash of 450 crores. And since I'm an LBO artist, I want to see what the best leverage I can get out of this cash flow. I'll take an interest cover of about 1.2x. Interest payable as a result is about 375 crores. And then at 10% interest rate, which to my mind is a very high interest rate for the times because GSEC yields were somewhere in the region of 6.5%. But just being conservative, say it's a 10% interest rate, you would have a debt capacity of about 3,750 crores. Now, if I'm Blackstone and I'm looking to do an LBO on this name, I know that the total debt capacity of this name is 3,750, and I add 10% of that as my capital, say 375 crores. The total capital available to me to invest in this business is say about 4,100 crores. As the previous slide indicated, the stock had a market cap of about 2,000 crores, and we've been able to generate over 2x the capital through debt and partly through equity. Now, if I was to be a buyer of this name, I would pay 2 times the current market cap. Tell the existing shareholders that I want to buy your company at 2x the current price. Why don't you sell it? And given the fear prevailing at that time, it's not unlikely that the current owners of this stock will be willing to take this, option and sell the company to me at over 4,000 crores, 2x the price. What I would do thereafter, if I was to buy this company, is I would merge my SPV, which I created to buy this company with Patni, use Patni's cash of 2,000 crore to pay off my debt, half of my debt the same day, through the operating cash of the company, assuming that this cash doesn't even grow, it continues at the same level. In the next 5 or 6 years, I would repay the remaining debt on this stock, on this business, through the cash flows of the company. And thereafter, the 7th year onwards, I would have a 450 crore operating cash flow stream available to me, having invested only 375 crore capital into this business. That is my own equity capital into the business. If you were, this is just a thought experiment, but if you were looking to invest your money in a business, would this sort of a trade-off excite you or not? I don't think it wouldn't excite anyone amongst us. This would be a very exciting trade-off, and this is the benefit of looking at a stock as not a ticker, but as a business which throws cash. And looking at it from that perspective, I can make bets which are very different from what the prevailing view of the market is. I can take calls on businesses where the risk reward is highly favorable to me and where I can generate cash flow streams for my own self at very attractive terms at that prevailing time in the markets. Now let's move to what are mispriced bets. Here, let's look at a quote that Munger made years ago. And I can tell you, you can read books and not learn as much as you can learn through individual quotes of some of these greats, because it is their collective wisdom. It is the wisdom of their years of experience, which translates into that one quote. What Munger says here is, to us, investing is the equivalent of going out and betting against the pari mutual system. We look for a horse with one chance in two of winning and which pays you 3 to 1. You're looking for a mispriced bet. That's what investing is. And you have to know enough to know whether the bet is mispriced. This is what Charlie Munger says. Now let's expand this and look at it in practical terms. This is just a quote. Let's go behind what goes into this quote. Let's look at horse racing. Horse racing is a game of skill where you are betting against other bettors. It's not a game of chance where you're betting against the house, which is what, say, a roulette is. And which is why, since you're betting against other bettors, there will be times where you will create edges for yourself to make money. Now, in this example, I've taken a 3-horse race. There is horse 1, 2, and 3, and the total bets placed on these horses are about 35,000 rupees. On horse 1, 20,000, horse 2, 10,000, horse 3, 5,000. In essence, if we assume that there is no transaction cost in this trade-off, then for horse 3's victory, I would get a payoff of 1 to 7, right? I invested 5,000, but I would get 35,000 as my payoff if I was right on this horse, which means the odds are 6 to 1. Now, this is what the other bettors have they've kind of placed this bet on this horse, assuming that these are the odds of victory of this horse. But once in a while, what happens is that horse 3 will be lighter, better suited for the conditions, will have rested well. So his chances of victory end up being 20% rather than the applied odds. And if the chances of victory are higher than what the odds seem to suggest, then you have a value bet, because you are more likely to win than what the odds suggest. And so the pricing you are getting is more favorable. Actually, you should be, for 5,000 invested, you should be getting paid 25,000 if you were winning. But in this case, you would be winning 35,000. So that offers you a value bet. Many players, in this case, other players are setting the price, and our objective as a bettor in horse racing should be not to identify the most likely winner. Actually, our skill lies in determining which horse or horses are offering favorable odds that exceed the actual chances of victory. It is there that the bet is favorable to us. It is there that our skill determines over a long period of time whether we make money or not. Because if we are betting on underlays, where say the odds of victory of horse 3 were say 1 in 10, and the payout is going to be 1 in 7, in that case, over a long period of time, we will be losing money if we continue to make such bets. But if we are making bets where the chances of victory are 20% and the payout is 1 in 7, then in that case, over a long period of time, we will be making money on our bets in horse racing. A famous horse bettor, Stephen Christ, in fact, I would urge you to Google some of his papers and read them. He says, there is no such thing as liking a horse to win a race. Only an attractive discrepancy between his chances and his price. That is really the nub of betting And I'm taking this example. I'm going to use this example to go to equities and explain to you how we apply the same in equities. Let's look at one example to further elaborate my point. Curious 2 years in Century Ply's long life. In April 2020, in fact, I should tell you that we were in my funds buying Century Ply prior to April 2020, which is COVID period. We were buying this since end 2019 to beginning 2020, and our average purchase price was about 160 prior to COVID hit, and we had about a 2 to 2.5% position in this name. The stock promptly, when COVID hit, fell to 110. Now, the sort of as they say in Hindi, duvidha in front of us was, what should we do? Should we believe that there is something wrong with this company and sell out this name, given that it has fallen so much? Or should we continue to hold, given that markets are reacting to, I mean, the stock is reacting to market conditions, but the fundamentals of the business remain strong? So this was the dichotomy that we were caught in, and we were thinking about how to look at this business. What we did is we did a reverse discounted cash flow on this name to understand what expectations are really built into this company. And what we realized is that the expectations built into this company are as given here. Sales growth for the next 10 years of about 5%, sustainable margins of about 13%, and implied terminal growth of 0%. So basically, the street was expecting, as we all know, the stock price reflects the collective wisdom of market participants. At that particular point in time, at 110 bucks, the collective wisdom told us that this stock has, they expect that this stock will grow at 0% over the long term, and that it will grow only 5% over the next 10-year period with margins of about 13%. And when we went back into the numbers of the company had in the past done anywhere from 15 to 18% EBITDA margins. At that point in time, it was doing about 13-14%, which is what the street expected it to do in the long term. Now, it was our job to understand whether these expectations were giving us a value bet. Were these expectations mispriced? And so what we did is that we looked at a macro picture. This is what the macro picture looked like. There were about 100 million households which were to become homeowners. That is about 10 crore households who were to become homeowners in the next 10 years. This was an industry report that we looked at. Of these, the upper and middle income category were about 17 million, about 17% of this total category. And which means about, if you were to equally distribute it over a 10-year period, then about 1.7 million households per annum were to generate home ownership in the next 10-year period. This is upper and middle income category. Total construction cost of a house in this category, we assumed, would be about 1 crore of rupees. To be more conservative, we could have done 50% of this number, but let's take 1 crore, which means that the total cost of construction would be about 17 lakh crore per annum to build these houses for this category. Now, plywood is about 10 to 15% of total cost of construction of a new house. Assume that this number conservatively is 10%, which means about 1,70,000 crores per annum would be the total market size of plywood if this situation was to play out. And of this 1,70,000 crore, 50% would be in the organized sector, 50 in the unorganized sector, which means about 85,000 crore per annum would be the total market available to a player like Century Ply. for only the upper and middle income category. I'm excluding the rest. Century Ply's FY20 revenues were 2,000 crore, and they had a market share of between 10 and 15%. So you can well imagine for a 85,000 crore per annum market, they were doing only 2,000 crore revenue. And this includes, of course, MDF, plywood, their laminates business, all of that. So the room for growth for the industry leading player was so substantial that it was really not getting reflected in their revenues, and definitely not in the growth pattern that the street expected this company to have, where they expected a 5% growth for the next 10 years and a terminal growth of 0%. So clearly, the expectations were mispriced in our judgment for a name like this. What happened in the next 2 years is stock went to 700 bucks. If you had invested a crore of rupees at that time in Century Ply, it would be 7 crores in 2 years. And at 700 bucks, we again did a DCF, a reverse DCF. And we figured that the sales growth now expected from this company was about 12%, sustainable margins of 19%, and implied terminal growth of about 6.5%. Clearly, the expectations had moved up quite meaningfully. This left no room for error for us. And as a result, we did trim our position at this time. Now, you will see here that it's not like we are doing some very expansive, very sophisticated calculation on what the value of this company will be. What we are doing here is something very simple. We are finding proof by contradiction. And we are using this over prediction of future. We are just saying that what the market is building in here, which is 0% growth, is highly conservative. And in reality, the market size, market opportunity tells us that in a name like this, the future will be much brighter than what the market seems to suggest today. In essence, when growth came, it was actually growth was option value. And when growth came, in our judgment, that would unlock value for this company. And it is precisely that happened in this name. As growth came in a quality name like this, industry leading name, zero debt, it had a very strong balance sheet. It had room to deploy its capital in its business, in multiple businesses that it had in its repertoire, and at high ROICs. All of that we were getting at an option value of zero growth. We thought this was a highly favorable bet. We made a ton of money on this. In fact, we opened our arms and we said, "Jisko bechna hame bech do, we will buy." And 110, we bought a ton of stock, and of course, we made a lot of money on this. I can also tell you this doesn't. I mean, it sounds very easy today, but at that time, when all hell is breaking loose, to be able to, put your head together and to disassociate the stock price from the fundamentals is not easy. But it is really that which differentiates that and your gut, your strength, that differentiates how much money you make versus what is really happening in the markets. And I'm just giving you an instance of how we could identify through proof by contradiction a highly lucrative opportunity in the markets and take advantage of that. But investing is not easy. Investing is very tough. Let's look at two other examples, Asian Paints and APL Apollo Tubes. Now, we were invested in APL Apollo Tubes. We were not invested in Asian Paints. And between the period 2017 to 20, this is what the numbers look like. EPS growth of Asian Paints in this period was about 12.7%, while for APL Apollo Tubes, it was about 19%. ROE structure, 5-year average. I'm not taking 1 year, I'm taking 5-year average. For APL Apollo Tubes was actually higher than Asian Paints. But then let's look at the stock. Look how much pain we had to endure in this situation. We were buyers of APL Apollo tubes. And for nearly 3 years, and I've consciously taken the period till February 20, which is a month before COVID hit in India. Asian Paints was in this period up 56%, while we were about flat for a 3 year period. And our clients, and in fact, in the interim, the stock was down by nearly 40 to 45%. It did rebound a little bit, but at one point it was down 40, 45%. Our clients, I can, I cannot tell you how much grief we got for this one name. Every time a client would want to have a call with me or my team, this one name came up so many times, that why is it that you're holding a company, an unknown company like this, in your portfolio, and it's really doing nothing. It actually did nothing, the stock, for a 3 year period. The point I would make to them is that here is a company which makes 6% EBITDA margins, and despite making 6% EBITDA margins, it has a 30% return on equity profile. So clearly, there is something that this company does efficiently, and of course, it is a market leader. It has about a 40% market share. Something that this company does correct, which is why it is so efficient that it can generate such high ROICs at such low margins. But that didn't cut any ice. Nobody was convinced. The stock was telling a different story, which was very different from the fundamentals of the business. And in fact, if you looked at the price to earnings ratio, this company was trading at 19 times price to earning, while Asian Paints traded at 62 times. So on valuations also, this looked very attractive. But as I said, the stock really did nothing. However, if you have conviction, if you can disassociate the stock from the price, and you have the right process and patience, it pays eventually. This is what happened to the two businesses thereafter, post-COVID. Earnings for Asian Paints was just as tepid as it was earlier, while for this company, earnings growth accelerated thereafter. And this is what the stock did. Promptly in March of 2020, APL Apollo tubes again halved. Of course, Asian Paints also got hit, but not so much at all. So we were looking like jokers. Asian Paints holders were looking like heroes at that time. But take the 5 year period from October 17 to February 23, this stock was up 6 times, over 6.5 times, and Asian Paints was up 2.5 times. Clearly, our conviction and our understanding of this business and our ability to disassociate the ticker from the fundamentals and from the business paid off. We made a ton of money. Again, in a 5 year period, if you make more than 6 times your money on a stock, a crore becomes 6.5 crores. That's not a bad bet. Why it causes anxiety is because the returns were back-ended, not front-ended. And to an investor, if you don't have patience, if you don't have conviction in your calls, then it's going to be a tough ride. But having patience and having conviction in your calls is really what differentiates, again, whether you make money or not. Value investing is the art of taking advantage of mispriced expectations, as we did in this name, where we could understand that the collective wisdom of the markets is building in really nothing, just like it was building in nothing for Century Ply, is building in nothing for this name. And it is definitely not reacting to two fundamentals of the company, which in our judgment showed a very different picture. This is really what happened. As I said, process and patience pays. Now, the question that most people have in their minds is that cheap valuations is equal to mispricing. We will delve into this question a little bit deeper and try and understand whether this is reality or not. Statistically, if you look at companies which have low valuation, say 10 times earnings, 8 times earnings in the past, those companies will have generated better returns in the future than those businesses which have high multiples, 50 times earnings, 55 times earnings. That is mostly because the collective wisdom of the markets is building in a bearish scenario for the cheap valuation companies, and it is building in a rosy scenario for the expensively valued companies. In general, this is true. And so there is substantial room for the cheap valued companies to disappoint and yet not go down. And if they don't disappoint, that is, if they beat expectations, then the room for upside in those companies is quite high in comparison to companies which are trading at expensive valuations, wherein even if in many instances they were to outperform expectations, even then they don't go up much because most of the upside is already priced in. As I'm saying, in general, this is true. But that doesn't mean that all expensive looking valuations are not mispricing. We will go into a detail as to why I'm saying that. Let's look at real estate as a metaphor to understand mispricing. For many of you who are not from Mumbai, you wouldn't know this map. But for people who live in Mumbai, this is the map of Mumbai. If you're living on the western end of Mumbai, which is close to the sea, where if you can see the cursor, this around here, it is here that property valuations are relatively more expensive than if you were living in this part of Mumbai, this part. And as you go south of Mumbai towards this end, property prices go up further because this is the most, this used to be the business district. It still is. Nariman Point is right here somewhere. And so closer you were to the business district, obviously the property prices would be higher. If you were on the west and towards the south, you would be living in the most wanted properties in Mumbai. Now, this is Nariman Point. This is a place called Malabar Hill right here. And if you go up, this is Worli. On the eastern side, this is Lower Parel. Further east, this is Sivri. If you go further north, this is Kandivali. And then north further, this is Mira Bhayanda. Let's look at how these areas are priced in Mumbai. And I've taken this data from 99 acres. So this is a Malabar Hill property which is on sale for 27 crores. And the going price is about a lakh rupees per square foot. This is a 2,700 square foot apartment. This another property in Worli is going for 23 crores. Worli is further north from Malabar Hill, as I showed you in the map. And this property is going for 81,000 rupees a square foot. Then look at Lower Parel. Lower Parel, and these are all high quality properties, high quality locations and properties. Medium quality, Lower Parel, you have the property price of 59,000 rupees a square foot. And Sivri further east, 42,000 rupees a square foot. You go further north, affordable quality. This is Thakur Village, Kandivali East, 26,000 or 27,000 rupees a square foot. Mira Road, 15,000 rupees a square foot. Now, if you were to look at Worli prices, 81,000 rupees a square foot, it's not like they're cheap, right? Very expensive. But if you were to get these prices for Malabar Hill, then it would be cheap. If you were paying 81,000 rupees for Worli, it would be the right price. But that price for Malabar Hill where the value is 1 lakh rupees a square foot, you would be getting a bargain. So an absolute expensive price has to be seen in context of what you are getting for that price. If you're getting Malabar Hill, then you are getting a bargain. But if you're getting Worli, then you're getting a fairly priced property. However, what the mistake that value investors do typically is they look at this trade-off and they say that a Malabar Hill at 81,000 rupees, 81,000 is a very expensive price. And they want Malabar Hill at Mira Road prices because that's what they're used to, cheap valuations. However, unless there is blood on the street, unless there is some sort of a major catastrophe, it is highly unlikely that you will get a Malabar Hill at Mira Road prices. You will get, for some, uh, sort of need of an individual to sell and rake in the money because he has some need of capital at some point. He may sell Malabar Hill at Worli prices because he knows that Malabar Hill is worth 1 lakh rupees, but I'm in a hurry and I need the money tomorrow. So I will have to leave some money on the table for the money to come in immediately. And so I'm okay to give it at Worli price. For a buyer of Malabar Hill at Worli prices, that would be a bargain and he should jump on. But if you're hoping to get Malabar Hill at Mira Road prices, I don't think, I mean, then there would be a whole lot of people jumping in and taking the price up. They would be bidding and taking the price up. Or there would have to be something exceptionally wrong with the property to go at that price. High quality properties are highly unlikely to be available at affordable quality prices. Similarly, high quality stocks are highly unlikely to be available at low quality valuations. This is something that we need to really keep in mind. It took me a lot of years and experience to understand this. I'm making your job easy by putting up this slide. Keep this in mind, and in fact, I'll as we go further up, I will show you how Charlie Munger changed Warren Buffett's investment style by, in a sense, looking at this metaphor and explaining this metaphor to Buffett in a different way. Of course, he didn't use the real estate metaphor. That, of course, is different. But I'm just saying that quality, pay up for quality, is something that he brought to the table when he started investing together with Warren Buffett. What is the marker of quality in equity markets? We spoke about real estate here, and we can intuitively understand that in each city there are various types of eccentricities which make property quality. What is it about equity markets that make a stock quality or not? And the one marker that I use, and I think that it is, I mean, everything kind of comes into this one marker. It is return on invested capital. This is the most helpful measure to gauge quality of a business. You will all know, but I'll still repeat, ROIC is a calculation used to assess a company's efficiency in allocating capital to profitable investments. The ROIC formula involves dividing net operating profit after tax by invested capital. So this is really what the marker of quality is in a business. And I will take an imaginary example to explain this further. Assume there are two companies, and I'm showing the magic of ROIC. One generates a 6% ROIC, the other 18%. They both require 10% of invested capital as capex to continue their operations. Look at this calculation for company A with 6% ROIC. Over 5 years, it has invested capital of 146 rupees, and it has generated, to run the business, Each year, say in year one, it has 100 rupees capital, it generates a 6% ROIC, 6 rupees NOPAT is what it generates. It has a capex of 10 rupees, 10% of invested capital, which means it is short by 4 rupees to manage the capex of the company to keep the business rolling. How does it make good this 4 rupees short? It takes debt from the markets. And each year, on 6% ROIC, it is short on capital by so much. Over a 5-year period, it is short by about 24 rupees, which means that it has to take external capital to run its business because the ROIC is low. And in a sense, if the company, the stock price of the company trades at book value, in this instance, what will happen is that the enterprise value will ensure that the market cap comes down because there is 24 rupees debt which has been accumulated, and that has to go from the equity capital. And as a result, the market value of its investment over a 5-year period, in fact, comes down. On the other hand, let's look at company B. It generates 18 rupees ROIC. On 100 rupees, it generates 18 bucks. It uses 10 rupees for capex, and it has 8 rupees left as a shareholder to be deployed, either to be given back to the shareholders or to be, or to buy similar businesses, expand the company, or do other things with this cash. But this is shareholder cash which is available in the company. After 5 years, it has 49 rupees of incremental cash which is available. Now, clearly, this business is superior to the first business. And if I was an investor who had various options to invest, and I was, say, a owner of one of the companies, I would have options like put my 100 bucks in a fixed deposit where I will get 6%, put it in equities where I'll get 12%, put it in gold where I'll probably get 8-9%, other commodities where I will again get whatever 5 to 10% or maybe even more. And then I could even put that money in this business. If I was making this investment into the business, then for the effort that I'm putting in to run the business, at 6%, I'm not getting compensated well at all. Because at the end of 5 years, really, I'm putting more money from my pocket to run the business. But at 18% ROIC, I'm getting compensated well enough and far more than the other investments that I would have made, sat at home and had that return coming into my bank account. And so this effort is worth my while the first effort is really not. And hence, the marker of quality is really ROIC. How much return on my capital do I generate when I invest in this business is really what determines whether the business is a high quality business or not. Consistently high ROIC is a reflection of quality of a business and typically depicts competitive strengths. If a company has been generating high ROIC, then clearly there will be others who would want to get into this business and generate the same ROIC. But if there is more competition, then pricing will get impacted and your ROIC should ideally come down. If a company has been able to maintain its ROIC over a period of time, then it in turn, you don't want to do, if you don't want to do all the work to understand the competitive strengths of a company, then this one marker tells you that there is something about this company that allows it to generate consistently high ROICs. As a result, the competitive strengths of this business are quite high. And so, as I said earlier, and I repeat again, ROIC is a metric of high quality. This is what Charlie Munger says, over the long term, it is hard for a stock to earn a much better return than the business which underlies it earns. If the business earns 6% on capital over 40 years, and you hold it for that 40-year period, you're not going to make much different than a 6% return. even if you originally bought at a huge discount. Conversely, if a business earns 18% on capital over 20 or 30 years, even if you pay an expensive looking price, you'll end up with one hell of a result. So the key point is even if you pay an expensive looking price, even if you pay worldly prices, 81,000 rupees a square foot for a Malabar Hill property, 1 lakh rupees a square foot, the value is what is 1 lakh rupees a square foot. Even then, you will get one hell of a result if you were to do that. This is the change that Charlie Munger brought in Warren Buffett, and in a sense changed the trajectory of what Berkshire Hathaway did thereafter. It is this change that, of course, in my investing process, I also graduated towards, and I, in today's context, can well understand how important this one quote is, and this quote distills the wisdom of Charlie Munger, generated over years of investment into this one quote, and which is why this quote is in many ways more important than a whole book that you will read. It's the context of this quote and the importance only experienced investors over a period of time realize. What are the types of mispricing? In our judgment, mispricings are birthed by uncertainty and they are confused for risk. Mispricings are of two types. And of course, there will be many. I mean, this is my understanding of mispricing. Somebody with a much deeper understanding can have different views on this, but this is how I frame mispricings. They are environment centric and they are business centric. Environment centric, as in a market collapse, say a COVID period or a Lehman crisis period, sectoral headwinds which are specific to individual sectors. As we all know, real estate saw a bubble sometime around 2008, and maybe it continued till 2013. That created oversupply, and as a result, we saw nearly 6-7 years of a deep down cycle in real estate. Pharma, again, there were excess capacities created, not enough checks and balances in those capacities. As a result, exporters of pharma products from India faced significant hurdles because US FDA came down heavily on them, started looking at each facility very closely. Many facilities shut down, and so their operations suffered in that period. This was a sectoral headwind. Regulatory changes. In 2018, there was something called the market cap classification of mutual funds that was brought in by SEBI. As a result, many mutual funds, they kind of veered towards large caps and larger mid caps, and veered away from small cap names and small mid cap names. As a result, small caps and small mid cap names really got hammered out of shape, despite their businesses not being so bad. And on the other hand, large caps benefited immensely because there was a flow of capital away from the other segment towards large caps. So large caps held on, more liquid names did very well. Again, this was an environment-centric impact on stocks, and which is what caused mispricing. Business-centric, you could have temporary earnings decline, disruption caused by changes in distribution policy of a company. Many FMCG companies, instead of deploying distributors, are going directly to consumers. That shift causes temporary disruption, and as a result, earnings got, in many of these companies get impacted temporarily, which causes stock prices to come down and mispricing come up. Management uncertainty. Sometimes investors are very comfortable with a certain manager of a company, and that manager superannuates. As a result, investors sell the business, This has nothing to do with, I mean, their perception is with the manager going, the future of the business is uncertain or it's not going to do very well. But if it is a high quality company with the right systems, then even in future, despite the manager changing, there will be continuity. We've seen in, say, in the case of Apple, a legendary promoter, he died, and a new guy came in. The new guy took the business to greater heights. Behavioral, many times you are just, uncertain about the prospects of a company. That is, a fund is uncertain about the prospects of a company, and they sell the business without really any reflection of the strength of the business. That causes mispricings. Liquidity, sometimes small amounts of selling disproportionately impact the stock price because the stock is illiquid. That again causes mispricing. These are some mispricings. I mean, some segments of mispricing as per my assessment. Now, you have a mispricing, but what is relevant really in identifying mispricing and taking advantage of this? This is again, as I said, sometimes some quotes are really books in themselves. The kind of learning that you get from these quotes are, they're just so tremendous that you should really internalize these quotes. Stanley Druckenmiller, many of you would have heard of him. He is one of the most successful investors and speculators on earth. A track record of never having a down year and a 30% compounded return for the last 40 years, nearly, is just tremendous. He was in an interview, and this is what was asked of him. What kind of analytical approach did you use in evaluating stocks? He says, when I first started out, I did very thorough papers covering every aspect of a stock or industry before I could make the presentation to the stock selection committee. I first had to submit the paper to the research director. I particularly remember the time I gave him my paper on the banking industry. I felt very proud of my work. However, he read through it and said, this is useless. What makes the stock go up and down? Now, I've emphasized this one point. I can tell you that in every analysis that I do personally, this is the one thing that I focus on. I don't want intellectual satisfaction out of doing a lot of analysis on a company. My objective when I'm analyzing a business is to make money out of that business, and so this one point is what my focus area is always. That comment acted as a spur, is what Druckenmiller says. He says, thereafter, I focused my analysis on seeking to identify the factors that were strongly correlated to a stock's price movement as opposed to looking at all the fundamentals. Frankly, even today, many analysts still don't know what makes that particular stock, makes their particular stocks go up and down. The questioner asks him, what did you find was the answer? And he says, again, I've highlighted this, very often the key factor is related to earnings. This is particularly true of the banking stocks, chemicals, etc. I mean, that's irrelevant, but very often the key factor is related to earnings. Of course, there are many ways in which a stock will unlock value, but I can tell you again through my experience and having learned it from greats like this, that more times than not, it is earnings which leads to value unlocking in names. We have talked of mispricings, and now we are looking at what leads to mispricings going away. And again, I can't emphasize it more. Very often the key factor is related to earnings. Focus on earning power to distinguish between risk and uncertainty. Our focus generally as analysts is on immediate earnings. It is rarely on earning power. It is for this reason that we get mispricings. Because if earnings in the short term are going down and we are focused on earnings, we will sell that stock. Further selling causes the stock to go down further. And suddenly, what is uncertainty looks like risk. Stock goes down quite meaningfully. However, focus on earning power. Earning power is the company's ability to generate profits, and it is forward looking. It is not about what is happening today, it is about the change that is likely to happen in future. And that really is the earning power of a business. If a company, I mean, of course, I don't have that example in the presentation, but I'll talk about it. In 2014, or maybe late 2013, Britannia, the biscuits company, was totally out of favor. While other FMCG was doing very well, this company, despite doing volume growth of 13-14%, really no one looked at this company. If you looked at it closely, for the last 3-4 years, the company's EBITDA margin had been around 6%. But in the last 1 year, the company's gross margin had expanded by 2%. And that 2% had not flown down to EBITDA because the company was spending that incremental 2% in advertising and promotion. And as a result, it was using incremental profits to generate volumes rather than give it in, I mean, to show profits on the EBITDA line. And the markets really did not gauge this. Our assessment was the company is premiumizing, and it is also selling more volumes. As a result, it is seeing operating leverage, but that is not reflecting in the margins. However, as scale goes up, it is bound to get reflected in margins going ahead. Also, there were other triggers for gross margins to go up. Raw material prices were coming down. Sugar, flour, both were looking to come down in our judgment. So this stock trading at that time, I mean, this was a 35 or 40% ROE business, consistently FMCG company. This stock was what was trading at that time around 20 times price to earnings, what looked like 20 times price to earnings. But our judgment was that earnings itself are going to look much higher, which is why this 20 times price to earnings is not the right metric to look at this company. 1 year out, the company's margins started looking like 8%, that is EBITDA margins. Margins went from 6 to 8%. And you can imagine that on a large revenue company, when you see a 2% delta on margins, what kind of a profit growth you saw. So in a FMCG companies grow profits by 12-15%. We saw 40% profit growth. And promptly, the stock from then, in the next 2-3 years, in fact, the margins kept going up. They went to 11%, and now they're, I think, 14 or 15%. In the next 2-3 years, the stock, a large FMCG, well-researched company, was up 10 times. So focus on earning power rather than immediate earning is a highly lucrative measure or lucrative way to assess what will lead to the mispricing of a stock go away. These are all trade secrets I'm sharing with you. I'm obviously inviting more competition from you all, but I can still tell you, despite my telling you all of this, many of you will not have the behavioral traits to still go ahead and look at opportunities in this manner. In any case, the market is so wide, it's an ocean. You can look at some opportunities, I'll look at some opportunities. Maybe we'll look at opportunities together and make money. Earning power emanates from moats and entry barriers, growth and ability to self-finance growth, owner-operators, skin in the game. Many people say soul in the game. Corporate culture, this is very hard to replicate. It's also very hard to quantify. Corporate culture is something, if a company has it, it just has it. And if a competitor doesn't have it, it doesn't have good governance, allocation of capital to the right opportunity. Earning power of good businesses do not diminish. Earning power of good businesses does not diminish. Market values may come down since they are beyond anyone's control, but earning power rarely comes down. This is again, I cannot emphasize it enough. Focusing on earning power rather than immediate earning is one way to, or I should say, the most effective way to look for triggers for value unlocking in names, triggers for mispricings to go away in a name. Let's look at certain case studies. Public sector banks, bad businesses, very bad capital allocation, low accountability, low drive. In many instances, of course, not all, but in many instances, that is the case. And as a result, this is a space which has consistently lost market share to private sector banks. However, this threw up a very interesting opportunity recently. These were lower than average businesses trading at roadkill valuations. You had a situation where PSU banks, so these are this is gross NPLs of the PSUs and private sector banks. As you can see here, PSUs had as high as 14.5% gross NPLs sometime in 2018. This number went up from, I think, 3 or 4% all the way to 14.5%. It was largely because bad assets which were hidden under the carpet were by the by the government. They were really pushed. The RBI and banks were pushed to bring these assets, bad assets, out. Also, the IBC mechanism was put in place so that NPL resolution was made more effective and faster. As a result, we witnessed NPLs going up meaningfully over this period for particularly PSU banks, as also for certain private banks, but they were private banks of far better place than PSU banks. However, it was quite evident in this year that the NPLs have peaked and that they have started coming down because they were out in the open and they were getting addressed. What we saw is that in 2018, bank ROEs hit rock bottom, and then thereafter, the next year, they started moving up. ROEs and profitability started moving up as NPLs peaked. And now, if we looked at the COVID period, the PSU bank valuations were, and you can, this was the bank index, this is a bank index chart. Here, you can imagine that SBI, the large behemoth, was the largest weighted bank in this space. And despite that, and SBI trades close to one time book generally, in this case, it was trading at half of book. Despite that, around COVID time, the price to book of the PSU banking space was as low as 0.3, 0.4 times. So on 1 rupee of book, you were paying 30 paisa to 40 paisa for PSU banks. And quite clearly, the losses in PSU banks had bottomed out. The NPLs had peaked out, and it was showing up in numbers. Despite that, the market, because it was so recent that they had seen PSU banks do so badly, was really not taking note. And markets were not willing to put money behind these banks. Bear in mind, in 2014, the same banks which were trading today at 0.4 times book or 0.3 times book were trading at 1.2, 1.3 times book. So that much of a decline in valuations that played out in this phase for the right reasons, of course. I mean, there were many banks which really were on the edge of getting bankrupt, and they were merged with the larger banks. But this crisis was an opportunity. In fact, to me, it seemed like the trade of the century. It was a sure shot trade, or I mean, nothing is sure shot, but I should say that the probability of you making money on this trade was higher than any other trade that I have seen over the many years that I've been in investing. And so, if you gauge that NPLs are coming down, so the cost of NPLs will come down. That will mean profitability of these banks will go up, ROEs will go up, and that will, in effect, get reflected in valuations, price to book valuations. Then these stocks at 0.3, 0.4 times price to book have no downside. And if your thesis does play out, then upsides can be quite meaningful. Now, so much, I mean, many people are also wary of investing in banks because of the leverage nature of banks. But in this case, they had gone through scrutiny of RBI for nearly 6, 7 years. And it was highly unlikely that there were further skeletons in the closet. Most of the skeletons were really out. So you could have taken a calculated bet on this space. And really, I mean, I can tell you that on many names, a lot of money was made. Here, if you were buying into these names at this time, you were really positioning yourself to a positive black swan, which can be quite lucrative. If these banks did continue to do well, then from 0.3 times book, there was no downside, and the upside will be asymmetric. And as a result, you were positioning yourself to positive black swan. Now, just as an instance, this was a money control headline sometime in June 21. It said Bank of America Securities has upgraded Bank of Baroda to buy from underperform, raising its target price to 120 versus its earlier price of 88, target price of 88. Now, Bank of Baroda, this is what happened to the valuations of Bank of Baroda. Around this time, which is the highlighted part, we saw that Bank of Baroda, I mean, in fact, in COVID times, it was trading at much lower than 0.4 times book. But in June 21, it was trading at 0.4 times book. And this was a bank which had in the past traded at 1.2, 1.3 times book. In not too distant the past, sometime around July 2015. So it came down so meaningfully in this phase. Of course, as I said, it was for the right reasons. There were a lot of NPLs which accreted to the bank. Profitability came down, and as a result, the stock also corrected. But look at the trade-off. Bank of Baroda assets were 7 lakh crores, which was over 3 times Kotak Bank's total assets advances, while market cap of Bank of Baroda was 1/10. So that was the disassociation between market cap and the asset book of Bank of Baroda. It was not a insignificant bank. It was one of the largest banks in the Indian banking space. And in the PSU banking space, I think it was second only to SBI. Now, thereafter, as NPLs peaked out, profit after tax went from rupees 1,600 crores to 18,000 crores today. That much of an upside, nearly 10 over 10x upside because NPLs came down, provisioning came down. So if you were focusing on immediate earnings, clearly this didn't look like an opportunity. But if you were focusing on earning power, that this company has 7 lakh crore of assets, it has gone through a bad phase. That phase seems to be coming to an end, not just for this bank, but also for the sector. And when that happens, provisions will come down, which will mean profits go up. You could have made so much money. Stock is up 3.5 times since the time in FY21 when Bank of America Securities came out with this report. So this was an asymmetric bet in the PSU banking space where you could have made so much money. This was on the one end of the spectrum, which is low quality space in general, where you had a significant opportunity. You in fact had, I mean, if I was to put it in real estate terms, you were buying Kandivali at Mira Road prices, and that offered you an opportunity. In fact, in this case, maybe you were buying even Sivri at Mira Road price. So it offered you an opportunity at that time. Now let's go to the other side of the spectrum, where you look at purportedly high quality businesses, and what leads to mispricing in those. Let's look at the case study of Tips Industries. Now this is a company. Many of you may know this company. It holds a repertoire, a library of songs of nearly 30,000 songs. It licenses out these songs to OTT platforms, platforms like YouTube, Spotify, Amazon, etc., who stream these songs on their platforms. And for each streaming, they pay Tips Industries. So if you and I listen to one song which Tips Industries owns, then in effect, by virtue of that, Spotify is paying Tips Industries 10 paisa. Um, that number is much lower for YouTube because YouTube has a much larger volume, but 9 to 10 paisa is what many of these OTTs pay Spotify. Now, there are many growth drivers in this business. There are industry tailwinds. Everybody is listening to music. Listening to music has become so easy because of OTT, higher internet speed, etc. The strength of content of this company is tremendous. It has a strong competitive positioning because there are only a few large players in this space. It has been acquiring new content. In the industry, there is a transition from 3G to 4G, and which will transition to 5G, which will make data even easier to source. And there is a tie-up with Wink and Meta, which is in the works, or which was in the works when I actually made this presentation on Tips Industries to an investor forum at the beginning of this year. So at that time, it was in the works with these uh, you know OTTs. Now, Tips Industries has an ROIC of 345%. That's how efficiently it deploys its capital. And that's how lucrative this company's business model is. Think about it. They just sit at home. They bought so much music over the years. They just sit at home, use this pot of gold to generate money for them. They don't have to do anything. People have to just lease out this asset from them and pay them as someone listens to their music. Their ROE is 57%. On the same hand, on the other hand, actually, a significant competitor of theirs, which is also listed, has an ROIC of 24%, ROE of 14%. Clearly, this company has a much better returns profile. The competitor's content is also older and less relevant, which is showing up in revenue per song, which is 29,500 rupees for the competitor versus Tips at 62,000 rupees and more. Now, Tips had given a 30% revenue and profit growth guidance for the next few years. And despite that, this company used to trade at under 20 times price to earnings exactly a year or maybe a year and a half ago. Now, if you look at high ROE, high growth companies, at some point in their trajectory, in their sort of long life, they have traded at 100 times price to earnings. Take the case of Page Industries, Symphony, ENIL, Sun TV, all have traded at 100 times price to earnings when they had a high ROE and a high growth trajectory. In those phases, they had very high multiples. But Tips with a 30% growth guidance and a 57% ROE traded at 20 times price to earnings and lower. If you looked at the business model, it was like a honeypot with highly repeatable content. You and I, if we want to listen to a song, we only want to listen to that song. And so we will keep going to that song. And if Tips happens to own that song, then we are getting attracted to that honeypot that Tips owns. And the music is the content is highly repeatable. You and I will watch a movie once, maybe twice, but if we like a song, we will keep listening to it. And so the content is highly repeatable. And that reflects in how the company has done. Company has grown nearly 3 times the industry between 21 and 24. That tells you that this company has been efficiently allocating capital and growing its operations very well. Now, this is the highlighted part is where the stock was trading at 20 times or lower price to earnings multiples. But you could, there was also reason for that. I mean, you could get anchored to the price. You could say that in the last 4 years, the stock is up 30 times. Look at it here. It used to be a 5 rupees stock in 2019, and it went to 150 here. So it's up 30 times in the last, say, 4 odd years. You could get anchored to the price and say that I shouldn't be buying today. But if you looked at the earning power of this business and saw the model in the context of that honeypot that I had shown earlier, then you could have disassociated from the price that it used to trade at 4 years back and where it trades today, and focused more on what the future potential of this business is, what the earning power is, and the stock from there itself is up 3 times. In fact, it had hit $500. It has also given a substantial dividend, and it has recently done a buyback at 650 rupees where the promoters did not participate. And really the yield on 150 rupees works out to over 10% for that buyback. So this is how lucrative this business is and how much cash it throws. And focusing on the right thing would have made you money on this name, despite the stock having done so well in the recent past. In the last section of the presentation, let's touch upon margin of safety and not losing sight of asymmetry. This is what Warren Buffett says. He talks about positive correlation between risk and reward. He says sometimes risk and reward are correlated in a positive fashion. If someone were to say to me, I have here a 6-shooter, which is a pistol, and I have slipped one cartridge in it, why don't you just spin it and pull it once? If you survive, I will give you $1 million. I would decline, perhaps stating that $1 million is not sufficient enough for the risk that I'm taking. Then he might offer me $5 million to pull the trigger twice. Now, that would be a positive correlation between risk and reward, because the probability of that bullet hitting me goes up, but along with it, the payout also goes up if the bullet doesn't hit. So this is a positive correlation between risk and reward. Now, on the other hand, there is inverse correlation between risk and reward. The exact opposite is true with value investing. If you buy a dollar bill for 60 cents, it's riskier than if you buy the dollar bill for 40 cents. But the expectation of reward is greater in the latter case, because 60 goes to 100, you make whatever 60%, 66% return on this trade-off. On the other trade-off, you make 2.5 times your money if 40 goes to 100. The greater the potential for reward in the value portfolio, the less risk there is. So there is inverse correlation between risk and reward in the value portfolio. However, investors shun out of favor stocks due to loss aversion. When they see a stock going down, they say that it has gone down to 40 cents. What if it goes down to 30 cents? And it could well go down to 30 cents. But if we believe, and our assessment is, that the value of this stock is $1 and we're getting it at 40 cents, that trade-off itself is highly lucrative. If it goes down further, maybe we could buy more. But investors don't invest in such opportunities because they have an innate tendency of loss aversion. Let's look at loss aversion from the prism of sport, tennis. In second serve, players utilize a slower second serve to avoid committing a fault and losing a point. As per ATP, the winning percentage of second serve on average is 10% lower than the first serve. So basically, people get cautious when they have to do the second serve. The first serve has faulted. They become cautious in the second serve. Interestingly, though, the highest ranked players also have the best hit rate on second serves. Second serve points won on Nadal for Nadal are 57%, similar for Federer. So clearly, they are not loss averse. They go all out for the second serve as well. And the results that they generate out of this are quite attractive for them. Same thing happens in the markets. This is something that I believe in and I have benefited from. Never waste a good crisis. Times of distress have been the best times to invest. True for markets as also for individual stocks. Look at various periods of distress and look at how the markets post this distress have performed and what kind of returns the markets have given post this period of stress. It's just a no-brainer to be looking at times. I mean, in fact, seeking out times of distress, hoping for, I mean, in a pyrrhic sense, hoping for times of distress, because it is then that you will get value which is favorable to you, and at that time you have to avoid loss aversion and go out and put your monies to use. As I said, it is at these times that the markets overall are mispriced, as also individual opportunities are mispriced. Letting go of loss aversion is the biggest advantage that you will have over the broader markets to make sure that you make money. In summary, stocks are fractional stakes in businesses and not tickers. Seek asymmetries through mispriced bets. Cheapness of valuations does not necessarily equal mispricing. ROIC is the clearest indicator of quality. Look for factors that make a stock move up or down. As I did speak about earning power, look for earning power over immediate earnings. Focus on margin of safety and avoid loss aversion tendency. Thank you.
Thank you
I'm
so
open
much,
to questions.
Anshul, for a very insightful presentation, and thank you for sharing your wisdom with our members today. It's always a pleasure to listen to you as you're able to synthesize complex situations and concepts into simple and easy to understand metrics. I'll request everyone to now type in your questions in the Q&A tab. If you would like to ask your questions live, then please raise your hands. We can also take up a few questions live today. And Anshul, as the questions are building up, one question from my side is on position sizing in a portfolio construct. You gave the examples of a plywood company and a tubes company, where the stocks were trading cheap versus the fair value, and the street had not identified the value yet. Stocks were, lagging the market. So how do you navigate that? How do you build positions? And especially now that you run a family office where your style can be far more unconstrained versus in the previous avatar where you were running as a professional fund manager.
Gaurav, that's a very important question, and I think that I will put two different hats when I answer that question. I've been a portfolio manager, professional portfolio manager, and now I'm a private investor. As a portfolio manager, my investors are looking to me to not only generate returns, but also generate returns at low volatility. And and greater the concentration, greater the exposure that my portfolio has to volatility. And as a result, I need to be quite mindful of what position sizing I have and in what names, so that my volatility of the portfolio is lower. Now, I can just on that aspect, of course, there are other things about lowering volatility, but just on that aspect of position sizing, what I really need to do as a professional portfolio manager is to ensure that the stocks that I have in the portfolio as large weights are going to be are going to have lower volatility. And stocks where there are chances of higher volatility, I don't go beyond a certain size. To give you an instance, if I was building, say, a 10% position in my portfolio, and I needed to sell that position in 1 week because for some reason all my investors have come back and said that they want their money back, then I'd better have an HDFC Bank in my portfolio because I will be able to take that money out in short time and return to my investors. If I have at that time in a 5,000 crore portfolio, say 500 crores invested in a 1,000 crore market cap company, then there is no way in hell that I will be able to take that money out and give it to investor. Also, if there is volatility in the markets in general, and that impacts the small and mid caps more, then my 10% position in a 1,000 crore company will definitely get impacted far more than it will get impact than in an HDFC. So I need to be mindful of that and position my position accordingly. Of course, there is an element of my conviction. If I have high conviction in a name, even if it is uh, an illiquid name, instead of having a 10% position in the normal course, I would have had a 2% position, but I could raise that to 3 to 4% because I have high conviction and I see triggers playing out for this business to do well. But by and large, position sizing is very important for the professional manager to ensure volatility comes down. Second, as an individual, my style is of high concentration. I'm not, firstly, I'm not running a 5,000 crore portfolio, so I don't have to worry about low liquidity. In my portfolio, liquidity is not less of a concern because I can sell my position in short time. And so my concentration, I prefer a 10 stock portfolio, maybe 10 to 15 stock portfolio, because I believe that your conviction should get reflected in the position that you're holding in your portfolio. And that, you know, I mean, a 2% position, if it goes up 5 times, it becomes 10% of your portfolio. But if you're convinced that your position is going to go up 5 times, and it is a 10% position, then you make 50% of the portfolio, I mean 40% of the portfolio to that position. So understanding risk reward and concentration is my style. But I've worn different hats at different times, and I would position different positions accordingly based on what hat I'm wearing.
Sure. Well understood. I'm opening up the line for question from Srimant Dudoria. Srimant, you
Yeah.
can ask your question.
Am I audible?
Yes,
Yes, you
please
are.
go ahead.
Hi, Mr. Anshul. Thank you for the insightful presentation. My question is, how do you decide when to sell stock? What factors do you look to sell a stock? Can you please brief on that? Thank you.
That's a very important question, Shriman. So there are three broad triggers that I have in my mind when I want to sell. One is where my thesis is not working, that I built a certain thesis on a name, and that thesis, that the way the business is progressing, it's quite opposite to how I had envisaged this business will do. In that case, I have to really reassess and take a call whether I want to hold on or sell. In many instances, I do sell. So I don't know if it is Druckenmiller who says it or one of these guys. They say that you should have strong views loosely held. That is that you have to have strong views about your analysis, your thesis, but you have to hold them loosely so that you are flexible when the situation changes. That is one uh, area where I will sell. Second is that I bought a stock worth 100 for 50. It's reached 100. I see. I kind of go back to the drawing board and see whether this 100 itself has moved to 150 or is it still 100. If it is still 100, then I have to exit. Just be dispassionate and exit. That's when I exit. Third, where I bought something which was worth 100 for 50. It has reached 70, but I found something else which is worth 100 but trading at 30. And I see that the triggers are imminent. I will then take monies away from this and put there because capital is scarce and I have to put best use. I put my capital to best use. Finally, I mean, these are three triggers that I have, but I also will go back to a point that I made in the presentation where most analysts are focusing on earnings and they are not focusing on earning power. That throws opportunities in the sense that if I believe that a company is going to go through tough times on its immediate earnings, because say the raw material prices are going up, or the demand scenario in the environment is going to be weak in a current period, because there is oversupply in the market or some such thing, then I know that analysts are going to look at immediate earnings and rate a company accordingly, which is why it's likely that a stock either comes down or it stagnates at a certain price for a long period of time. Knowing that this is the tendency of the markets, I will look at taking my monies out and selling, or at least trimming my position, putting that money to use elsewhere. This is how I frame my sell decision. However, I should also make a point that I never ever sell just because the stock is up. Because I've seen, and again, as I said, sometimes individual quotes are more relevant than books itself. Warren Buffett, despite his experience in value investing, says that you should never cut your flowers and water the weeds. Let your flowers bloom. So stocks which are doing well, I mean, I should give you an example because I'm rambling, but let me give you an example. We bought Polycab in 2019. The stock used to do nothing. We bought it just after the IPO at $600, and I could have lost my job just to buy that because everybody in Kotak was negative on that, from my CEO to the head of our business. Everybody was negative on that name. But it was the biggest position in our portfolio because I understood why there is such a dissonance in how well this company is running its operations and how the market perceives it. And I could understand why that will change. So we bought it $600. I could have sold it at 2,000 rupees. I could have sold it at 2,500 rupees, 4,000 rupees, 5,000 rupees. Today it is 7,000. So riding your winners when something is doing well, just riding it is in itself an art. Never get carried away by a stock having done well, because stocks can do very well from having done well. And many times, if the market is agreeing with you, just let it ride.
Thank you. Thank you. Just a follow up on the last point that you mentioned. If the stock is doing well and the business is doing well, do you still consider holding it? If the valuations catch up more than what you what you had estimated initially as a fair value valuation to that business.
Many times not, but sometimes yes, because I'm always assessing what the growth pattern of this company is and whether that growth pattern is accelerating or it is decelerating. Now, in certain instances, growth patterns will accelerate, or at the least, they will remain at the levels that they are today. In which case, there is every chance that a high quality company will be re-rated further, because greater liquidity leads to greater interest from the institutional community. And that means that more and more people jump in and take the stock price higher. And as a result, in those instances, despite the valuations being slightly higher than what I would be comfortable with, I just continue to hold, because who am I to decide what the markets can value a company at eventually.
Thank you so much. It was very helpful.
Thank you.
Thank you, Srimant. Uh, there are a few questions, Anshul, in the chat box related to ROIC you talked about. So Shubham, Amritpal, and Bhupati, they wanted to know about ROIC, especially compared to ROE. So if we can use the two matrices interchangeably, and also the quality of the reported earnings as far as the ROIC itself is concerned. While it's a session for it's a topic for a full-fledged session itself, but if you can throw a few points on that.
You can, see, one is that this is not an exercise in being exact. You are not trying to be extremely precise in your assessment of a situation. If a stock does or a business does profits by your calculation of 140 crores, and someone else is calculating 143 crores, that I mean, it's better to be exact, but it's what is more important is the trajectory rather than one particular metric. Why I said that is because while ROIC and ROE are two different things, but you can use them interchangeably in certain instances, or just to understand the direction. ROIC is more about incremental capital which is getting deployed in a business and generating what returns is that capital generating. ROE is more a static approach to what the return on equity is today. Now that differential determines what the company is going to do in future, because at the end of the day, if ROIC goes up, it will in effect get reflected in ROE as well. And more times than not, a rising ROE or a rising ROIC leads to multiples expanding. So while they're not absolutely the same thing, but I would say that both the change in both change in one gets reflected in the other. And so that's what you should be worried about, much more than the precise exact figure and whether both the figures are the same or not.
Well understood. Open the line for Vineet Khatri. Vineet, you can go ahead and ask your question.
Okay, am I audible?
Yes, please go ahead.
Thank you for giving me this opportunity. Anshul sir, I have a question. Like what I do basically for screening such stocks is go to the screener and put a basic screen, right? Okay, on the median P or basic return ratios, like, okay. How do you at Kotak scan for such opportunities? Like, do you also use such basic filters on the numbers part, or you use other data?
Again, Vineet, this is not, you can't use just one metric to filter companies. Maybe just one metric works for someone. For me, I look at stocks through various prisms, try and understand situations of stocks by going through various mechanisms of analyzing a company. I could be putting a filter to get a certain perspective. For instance, I could look at last 3 years revenue growth of 15%. I'm just giving an instance. Last 3 years free cash flow growth of 15%, and stock 25% lower than all-time highs, when every other stock is at an all-time high, or stock 25% lower than 52-week highs. I could look at stocks which are trading at 52-week lows. I could look at stocks where there is a preferential allotment of equity to the promoters. I could look at stocks where promoters are buying. I could look at stocks where rights issues are being done. So there are various ways through which I try and gauge where is it that I get an opportunity? Where is it that there is an opportunity? I could even seek out businesses where there is management change and new management is coming in which will lead to newer energies into the business. So various ways of identifying opportunities, listening to con calls. I mean, the kind of information you get out of con calls and the edge you create out of that, I cannot overemphasize. So, as I said, many ways of finding opportunities.
Okay, got it, got it. Another question, sir. Uh, how do you evaluate these scenarios where a holding company, right? A holding company has a subsidiary, and that subsidiary's value itself is more than that holding company, but the market value of that company is much lesser, just like in case of this Bajaj Group, or even recently I saw this EID, also EID Perry, where EID Perry holds 50 odd percentage of Coromandel International, and where Coromandel itself has a market cap of around 40,000 crores, and EID just trades at 16,000. Do you consider this as a mispriced opportunity?
Not necessarily. See, again, uh, you have to keep in mind that um, if something has traded at a certain valuation for an extended period of time and not deviated from that, then in the market's wisdom, this is the value that will be ascribed to that company. It doesn't matter what you and I think. Um, and in case of holding companies that you mentioned, in that case, clearly there is a holding company discount which is ascribed to the businesses that they are holding, and that discount is ascribed because investors say that the benefit of this company, that is, if there is equity shareholding in this company, that benefit is not going to come to shareholders. They are not going to sell the equity and pay that money to the shareholders, and the cash flow of that company is with the company. That cash flow only comes to the holding company in the form of dividends. It doesn't come to the holding company in the form of 100% of the cash flows flowing through to that company, by and large, more times than not. Certain cases it may be different. So, in that sense, why should we not buy that business directly? Why should we buy that business through the holding company? Um, and I have seen that even in this case, generally value gets unlocked when in phases when the holding company, the company that it is holding, the subsidiary, that company starts doing well. So if say EID Parry holds Coromandel, if Coromandel starts doing well, then EID will unlock value. In which case, I mean, I would buy Coromandel itself. Why should I buy EID only? Because Coromandel will also do that. And so uh, you in holding companies, you have to really hold for a long period of time for the discounts to get bridged, that to come down. And there are many these sort of small arbitrages you will be wasting your time in. There are many more attractive large opportunity companies there in the markets where you could spend more time analyzing them. Of course, it's simpler here. You know the math, you can put it on Excel and you will get an answer. But there you will have to do more analysis. But I can tell you, if you find more lucrative, large opportunity companies, you'll make more money there rather than this. I don't waste my time here. I look at those opportunities.
Got it, got it.
Yeah,
Thank
thank
you
you,
for
Vineet, for your question. Next question from the Q&A tab. Two questions from Suraj Jain. So Anshul, he wants to know if you also use technical analysis in the way you manage your portfolio.
I don't, because I don't know technical analysis. One is that, but I do hear of smart people. Even Stanley Druckenmiller says that he uses technical analysis to decide when he wants to enter or exit a stock. So clearly, if he's saying it, he's not fooling around. He means it. There must be some benefit to technical analysis. I have not. I have no way of assessing it because I don't understand technical analysis. But off and on, if I'm buying a stock or I'm looking to take a position, some technical analysts who I have seen over the years and who I happen to know, I take their opinion. what do they think about a certain opportunity? And I put that into my calculation. I mean, whatever weight I want to put to that view, I put, and I decide whether I want to get it.
Got it. There are two anonymous questions, but they're related, so you can club both. They're talking about, value trap. So if you can give any example of a situation where you felt that it's a mispriced bet, but it happened to be a value trap, or if there are ways in which you can differentiate between the two.
Yeah, let me give you an example where uh, I myself didn't make money, even though that position looked very attractive. I bought into a company called Noida Toll Bridge at one point, and it was a special situation because the company, whatever earnings it used to make from the toll that it would generate from its road, it would pay out to shareholders, more or less. And that number used to work to a 10% dividend yield to the existing shareholders. I thought that that was very lucrative. I bought in, but what I realized from that trade is that this company has only one road. There is very, I mean, it's it might see some volume growth because there is traffic is going to increase between Delhi and Noida, but there is no way that they will be allowed to raise prices because of XYZ reasons, political, etc. And it's not going out and buying new assets to grow its business. So there was no way that the company was going to see significant growth, and hence the dividend yield, which was 10%, and if I was banking on that dividend yield becoming 5%, and so the stock price going up to 40 from 20, that wasn't going to happen. It was a hard learning. I held it for a year, didn't make any money, maybe I lost 10-15% of my money, and in that time other stocks did very well. So essentially, my cost was not just that 10-15%, it was the opportunity loss because I could have deployed my capital elsewhere and made a ton of money. So value traps are essentially, as I see them, are companies where you are not seeing growth. And as I mentioned in my presentation, more times than not, it is growth which is helping you unlock value. If you're not seeing growth, it's unlikely that value will get unlocked. This was these kinds of arbitrages where you're hoping for value to expand despite earnings growth not being there. I stay away from, and these are what value traps are.
Sure, thank you. Next question from Pawan Kumar. Pawan, please go ahead.
Yeah, thank you for the opportunity. My question is, as Sir has talked about loss aversion, consider situation, suppose I am already putting around 10% of a bet in a certain stock, and it again goes down due to some maybe some volatility or some reasons which are not fundamental. Would again, is it prudent to buy even considering already I am optimum allocated? Considering you have given an analogy of second serve being used by the tennis players.
Pawan, again, it depends on your assessment of value and your risk appetite. Now, I don't, as an individual, I don't mind going 15-20% of my portfolio in one stock. If I find an opportunity where I think that my assessment tells me that this stock is going to be worth 100, I bought it at 50, it's gone down to 20. And my position size was optimum, then I would think twice. But if it was, say, my position size was 5%, it's gone down by half, and I think that I can build it to a 10% position. I don't think I will bat an eyelid. I think if my assessment is that this business is worth much more than what it is trading at, I will build. Of course, it becomes tough if you think that you have a full position in this name. Then it becomes a little tough. But if your position is not full, um, even if it is full, I would say that you should. I don't know. The answer depends on each person's risk appetite, but I would add further. I don't know if that is your risk appetite. Maybe you can do it also. If it isn't, then just let it be. Let the position size be as it is.
Anshul, can you give some maybe example from your experience where you have really done that trade, if possible?
I can. I mean, I can tell you that in RVNL, Rail Vikas Nigam Limited, we bought it at 22, 23 rupees. The stock in COVID time, and we had about a 4-5% position size, which typically is what the position that we retain. I mean, we don't, at least in my professional portfolios, we would not go higher than that typically. In the odd instance, yes, but typically. And the stock went down to 11, 12 rupees. Now, the metrics I had in mind was that this stock generates 4 rupees EPS. It has revenues of 10,000 crore. The order book is 70,000 crores, which means 7 years revenues are already there in the order book. It gives 1 to 2 rupees dividend, which means at 11, 12 rupees, I'm getting nearly 20% dividend yield. Of course, it's a government company, but it has some sort of a monopoly in this business of rail infrastructure. Not too many other people do it. So we added more to our position, and of course we sold out early, but the stock thereafter is history now. It's about 370 bucks. So from 11, 12 rupees in 2020. It is up to 370 or 380 rupees today. So you have to have conviction in your thesis, and you have to know enough to know that this stock is mispriced to go ahead and buy more.
Thank you. Thank you for the answer.
Thank you, Pawan. We'll take the last few questions. Subramaniam, please go ahead with your question. Line is muted. Unmuted.
Yeah, thank you. Yeah, thank you. Thank you for the opportunity. Sir, my question is, if the stock is already if the stock fee is already 60, 70, and but the growth in the earnings is maybe 30, 40%. So how do you look at the stock? How do you evaluate the valuation? Is it considered as a fairly valued, or is it high overpriced? How to come to a conclusion?
See, I mean, it could turn out either. It could be undervalued, it could be overvalued. Just having 50, 60 times price to earnings is not sufficient understanding, sufficient data for you to judge whether that stock is overvalued or not. However, will I look at buying that stock? More likely than not, no. Because a lot of things will have to go right for me to make money from there. There is at 50, 60 times price to earnings, there is no room for error. However, if I was getting the same stock at 20 times price to, or 25 times, and I had an understanding that this is a high growth company, then I know that I have room for error or margin of safety. Then I will go ahead and buy. There is so much happening in the environment, and that I cannot focus on just one thesis and take a call that growth will continue in the future, and hence buying at 50 times, 60 times price to earnings makes sense. I could be proven wrong, but if I, in that one instance, but if I follow this discipline over my investing lifetime, then there will be out of 10 instances where I will be proven wrong on 2 or 3, but on 6, 7, I will be proven right. Because that is just statistics. High valued company, high priced companies typically generate low returns than low priced companies. So in that context, and also knowing that the market is an ocean, I will get many companies in this market. I don't have to focus on one or two companies which are the darling of the market's eye today. But for that reason, they are trading at such valuations. By doing that consistently over a period of time, I will save myself capital loss. I will also save myself opportunity loss. So that is just my choice. I stay away from such opportunities, such names.
Okay. Thank you, sir. Actually, one more question. How to evaluate the earnings power? You mentioned ROIC. So is there any qualitative metrics you look in for the company? If you can
So
elaborate on that.
I mentioned the qualitative aspects in the presentation, things like moat, competitive advantage, various aspects. I don't off the cuff recall, but those aspects are what you should look at. I will be sharing the presentation later. You will get it.
Thank you, Subramaniam. Taking one last question from the Q&A box, which is talking about the importance of cash position in the portfolio. How much percentage would you keep aside as cash, especially in a market like today where getting mispriced bets is kind of very difficult?
I don't have any cash. Just to let you know, I'm fully invested because I think that if there is, firstly, I don't care where I don't, or I shouldn't say I don't care. I just don't know where the markets are going tomorrow, right? I remember when I was in Kotak, every fund manager in the industry that I spoke with around March of 23 or April of 23 was of the view that you should be investing in large caps, not in small caps, small and mid caps. And small and mid caps have given 70-80% at the index level from then to date. So the most knowledgeable, the smartest people don't know. And for me to gauge whether the markets are going up any further from here or not, I think that I have to first tell myself I don't. And so what I know and where I can have an edge is where is it that I find mispriced expectations. And in all markets, I can tell you whether it is an expensive market or not, you find mispriced expectations. I like to say that a bull market is a narrow bear market, because in a bull market you will find certain stocks, like a small universe of stocks, which will have done nothing or which will have gone down because their industry dynamics are working against them. Similarly, a bear market is a narrow bull market, because in a bear market there will be a small universe of stocks which will have done very well because the industry dynamics are working in their favor. Now, I need to be looking for those arbitrages and then not worry about market conditions, because market conditions, I don't want to try to predict markets, because it's a zero-sum game. Once I win, the second time I lose. I just buy quality names. I buy them at reasonable prices, and I just hold on. If they go down, I bear the volatility. If I can take some leverage on my portfolio, I use that to buy more. But I don't think that it is a good strategy to be holding a lot of cash unless you find just crazy valuations in the markets. I don't think that this is a market where you have crazy valuations. I've seen worse times in 2007. I've seen crazy times in the .com bubble. We are not there yet, is my judgment. I mean, again, that is just me. I could be wrong.
So while there are still so many questions, but we run out of time, so we'll probably now close it at this point. Thank you so much on behalf of all the attendees today and the CFA Society. I'd like to thank for your time and sharing your wisdom with all our members. Thank you all to the attendees. We'll be sharing a soft copy of the presentation with you all over the email, and a recorded version of the session will be uploaded on the member website shortly. Happy to receive your feedback. Thanks again, Anshul, and hope to see you soon. Thank you all.
Thanks, Gaurav. Thanks, Gaurav. Thank you, everyone. Thank you, Vidhi. Thank you, everyone who's on this presentation. Thanks for taking out time. I hope I've added value to you all. Bye-bye.
Thank you.